do the same kind of thing, but now let's think about this scenario. Instead of recording it to the income account, I want to record it to sales returns and allowances because I don't like the income account going down, which is typically the case, right? We would like income only to be going one direction, up, and then possibly record another account called sales returns and allowances, which would be a contra income account. How could we do that? Let's do this again. So I'm going to say, all right, let's make another invoice. And we're going to say invoice. And we'll say this is going to be for customer 2, let's say. And we'll say customer 2, and then okay. And then let's say this happened on the 15th, let's say. And we'll just do the same thing. Item 1, or 155. So same scenario. What's this going to do? It's an invoice. Accounts receivable goes up by 167.40. Other side goes up to revenue 155. Difference 1240. Sales tax payable. Inventory is going down by $100, which is driven by the item, which knows what the cost of the inventory was. Cost of goods sold goes up by $100. Net impact on net income 155 minus cost of goods sold of $155 increase. And the subledger for accounts receivable will be tracked by customer number 2, and the subledger for inventory will be tracked by unit. All right, let's save it and close it. Save and close. So if I go to the balance sheet, once again, run it, we're going to say, all right, accounts receivable. Accounts receivable has now gone up again by the one on 115 for the 167.40. Let's go back. And then on the income statement, we're going to run it to refresh it. We can see that revenue went back up again by 155, back to the balance sheet. On the liability, we can see that in the sales tax payable, Board of Equalization, that went up by 1240 again. Let's go back, and then we know that the revenue or inventory went down. Inventory goes down by the 100, and the cost of goods sold on the P&L goes back up by the 100. Net impact on net income 155 minus 100, and the subledger for inventory will have been impacted again. It's back to 9 units, and we're at 149625, and over here we're at 149625. All right, so now if I go into the first tab and we go into the sales, we can look at customer number 2 now. Customer number 2 now has that invoice on the books. So we're going to issue a credit memo for that invoice, but try to adjust the income account so that it doesn't reverse income, but rather goes into sales returns and allowances. How can we do that? Not an invoice. That's not how you do it. Let's make a credit memo, and it's going to be for customer number 2. And let's say this happened on the 16th, just to make it a little different. We'll say this is going to be inventory item number 1. So there's the exact same thing we did before, which would reverse it. It's not quite calculating yet on the sales tax for some reason, but when I record it, it then calculates it. That's the little glitchy thing that's currently going on. So I'm going to be okay with that for now, even though it bothers me. But then I'm going to say, well, if I do that, what's going to happen? It's going to reverse the income account. I don't want it to reverse the income account. So I'm going to make another one, and I'm going to call this item sales returns and allowances. I'm going to copy that account, and then I'm going to add that account, and I'm going to make it an item. I'll just make it a service type of an item. And I'm going to say, it's not an account. I'm adding like an item, like an inventory item. And then I'm going to say, I'm not going to put a price in here, but I want it not go into the income account. I want it to go to a new account. This is where I'm going to create a general ledger account, adding an account. This is where I add the account, sales returns and allowances. The account type is going to be an other income. Other income, let's say, not dividend. We'll just say other miscellaneous income. Now it's going to be an income account, but it's going to go down. So description, that's good. So let's save it. So now And do I want sales tax on it? No sales tax on it. That's going to mess me up if I have sales tax. I'm going to say no sales tax on it. Okay, and so then I'm going to say, all right, I think that's it. Save it and close it. So now I'm going to say, I'm just going to put the same dollar amount here, 155. All right, so there we have it. So now it's recording it twice, but I'm going to remove the top bit. I'm not going to delete the line. I'm just going to make this 0. And so there we have it. And then I do want this to record the sales tax. So I'm going to check off the sales tax here so it's still recorded, even though it's not adding it up here. It's doing it. So you might say, okay, well, why would you do that? Well, this one, so this one's going to record it to sales returns and allowances, but I still need the top one if they return the inventory, because this top line, although I don't see the dollar amount of inventory, will still record the adjustment to inventory. Let's record it and go back into it and see if this properly calculates down here. So I'm going to save it and close it. And then I'm going to go back into it. So now let's go back into that credit memo. I'm going to edit it so I can see it. So now you can see it populated the sales tax. So what's this going to do then? Well, it's going to be a credit memo. It's going to do the same thing. It's going to reverse the accounts receivable by the full amount plus the sales tax, decreasing it by $167.40. It's going to reverse the income, but instead of reducing the income account, it's driven by this item, which is going to go to the sales returns and allowances account for the $155 instead of the income account. And then the difference of the $12.40 is going to be reversed still on the balance sheet for the sales tax payable, and the inventory is going to go back on the books driven by this item, which although is zeroed out, still has the item which knows that $100 of the cost of inventory is going to increase the inventory, and the other side is going to go to cost of goods sold. Now, what if the inventory was damaged or something like that? Well, then I would delete this line. I wouldn't need this line because inventory is not going to go back up in that case. So we wouldn't need this line at all, and I could just replace it with basically this line. Okay, so let's save it and close it and check that out. So if I go to the balance sheet now, I can run it, and the top bit will, oh, by the way, let's go to the first tab again. You can see once again that it created automatically the payment form, which basically just tied these two things together so that now the credit memo says it's been applied. So if I edit the credit memo, it's been paid, right? And I can see that by going to the made payment form, and it basically is gonna make this payment format that tied the two out. And if I go into the invoice, you can see if I go into this invoice, it says it's paid. If I edit the invoice, then I can see in here that it's been paid. It's tied to this payment form. And so there's the payment form. What's the payment form doing if I close this out? It's just tying the two things together. So here's our payment form, which once again, if I just take a look at it and edit it, then this would be the form that we would receive payment from. Normally the invoice would be checked off and we'd get a payment, but we didn't get a payment. It tied it to the credit memo. Okay, cool. So now let's go back to the balance sheet and just check it out. If I go into the accounts receivable, it went up and then back down again. Invoice credit memo. That makes sense. If I go to the income statement, however, which has been deleted now, what que paso to the income statement? What happened? Let's put it back in play. 0101 24 12 31 25. Gremlins, man. I'm telling you, it's the gremlins. Run it. Okay. So then I'm going to go back. So now the sales is still there, 155, and the other side is going to, oh, I put it down here to other income. I should have put it into just normal income, sales returns and allowances. I'm kind of annoyed about that. Let's go to the first tab and see if we can fix that. I'm going to go in and say, let's go into the transactions and say, okay, I'm going to go into the chart of accounts and then close this out. And we're going to say, donde está sales returns and allowances. It's going to be in the other income, other miscellaneous expenses. Let's go to the next page. There it is. I put it into other income. So let's see if I can edit that. Select the drop down, edit, and I want it not going to other income, but just normal income. Changing it. Changing, yes, change it. Change it. Make it right. Let's go back to the first tab, run it again. So now we've got the sales up here, and then I reversed it not to the same account, but to a contra income account. So it's still in the income section, but it's reducing the income. So this is like net income. I mean net revenue instead of net income, net sales, you could say. Okay, and then so there's that, and then the other side is going to the liability. Board of Equalization went back down for the sales tax payable. Good. And then if I go back, we know that the inventory went back on the books. So this is the one that if they return the inventory, the credit memo put it back on the books. So let's go back, and then the cost of goods sold also got reversed. You would think, why don't I do the same kind of thing for cost of goods sold? We just don't typically do it for cost of goods sold. So cost of goods sold is going the wrong way here, and we're going to be okay with that. Let's go back, and then the subledger for inventory, you can see, is back up to 10 because we received that unit back. And this 159625 should tie out to what's on the balance sheet, 159625. So there we have it.